and gentlemen, you're all welcome to the webinar entitled IFRS Revenue Recognition Applying the 5 Steps Model. It's Maroon Isghaib with you today. My name is Maroon. I'm the facilitator for this session, for this webinar session. I work with Meirc Training and Consulting as a consultant and as a trainer, specialized in the areas of finance, financial analysis, and financial reporting. I am a holder of diploma in international financial reporting standards from the ACCA, CPA, and a CFA charter holder. Today, the topic is about IFRS 15 revenue recognition. I'm sure that many of you started applying IFRS 15. I'm sure that many of you are attending training on IFRS 15, so I decided to run this webinar in order to polish our learning about this topic. And in case you have any questions about applying the 5 steps model, please, this is the chance today to ask whatever you want, and we'll have an open discussion. In applying the 5 steps model in IFRS 15, we should know that it does not apply to certain standards in IASs and IFRSs. IFRS 15 applies to all contracts with customers, but not to IFRS 16 leases, lease contracts. The lessor in a lease transaction, if he's selling the lease service, he would account for it under IFRS 16. Not the gains, dividend income, unrealized and realized gains of financial instruments that are under IFRS 9. It does not apply to IFRS 10 consolidated financial statements and the gain that generates from the bargain purchase or any transaction in IFRS 10. IFRS 11 joint arrangements, IAS 27, 28, and IFRS 17 insurance contracts. So all the income, revenues, or gains that are under those standards that I've mentioned above are excluded from this IFRS 15 revenue recognition. First, I would like you please to chat something into the box, if you can chat something, to make sure that you are hearing me and you are with us in this chat room. Okay, I can see Maruf typing. Please, if you don't mind, to type something in the chat box to make sure that we are all on the same page and you are hearing me. Okay, Ahmad, you are hearing me. I hope that the rest, I can see other participants with us in the room. If you would like, Ali, Hussam, Sharif, the others, please type something just to make sure that we are all on the same page. Starting with the 5-step model, I would like to brief you on the history of revenue recognition. The predecessor standard for revenue recognition was IAS 18 that dealt with revenue from sales of services and sales of goods, revenue from interest, which is the sale of financing, revenue from dividend and royalties. The new model, which is IFRS 15, covers IAS 18 and IAS 11, which was revenue from construction contracts. So IFRS 15 is a new standard that covers both IAS 11 and IAS 18. IAS 11 and 18 address construction contracts, sales of goods, and sales of service. But under IFRS 15, we have a single model for performance obligations, regardless if it's a service, regardless if it's a good, regardless if it's a combination between goods and services, all the transactions are looked at as a performance obligation. Are we performing the obligation at a point in time or over a period of time? And that's what defines when revenue should be recognized. The second difference between IAS 18.11 and IFRS 15 is that IAS 18 and 11 were based on focus on risk and rewards. So revenue was recognized when the company delivers or transfers the risk and reward to the customer, to the beneficiary. Under IFRS 15, the concept of risk and rewards is now included within the concept of control. It is not eliminated, no. It is within the concept of control. But control is a wider scope. When we say control, control is the ability to direct the use and obtain substantially all the benefits of an asset or a service. So once the benefit is transferred from the seller to the buyer, once the ability to direct the use is transferred, once the buyer has the ability to use the asset to produce goods or services, to enhance the value of other assets, to exchange or sell the asset, or to use it as a collateral or pledge, we can consider that control transferred from the hands of the seller to the hands of the buyer, and the seller can recognize revenue. Under the previous model, we had limited guidance on multiple element arrangements, if you are selling multiple services in one contract, multiple goods in one contract, a combination of goods and services in one contract, those were not heavily tackled in the old standard. Variable consideration was not heavily tackled, and licenses was not heavily discussed. The new standard isn't much different than the old standard, but it refines the description of multiple element arrangement on how to account for them. Under the previous standards, we used to apply professional judgment, our highest ability in professional judgment, to decide on how to account for the multiple elements arrangements. But in new standards, we have examples, we have illustrative examples that can help us do this. Moreover, variable consideration was a gray area under the old standard, and now it was somehow explained with examples. It was somehow elaborated, and users can now know how to account for bonuses, incentives, claims, variations on contracts under the new standard. Starting with the first step. The first step in the 5-step model is to identify the contract with the customer. We need to know if there is a contract. We need to know if the parties have agreed on something. And for the parties to agree on something, they must approve the contract. Approval of the contract does not have to be in writing, does not have to be signed. An acceptance of the good or acceptance of the service can mean the approval of the contract. The other component of approving the contract is identifying each party's right. Me as a seller, my right is for payment. You as a customer, your right is that I satisfy the performance obligations. I deliver for you something of good or service, and the transaction must have a commercial substance. It must not be a free transaction. Identify the payment terms, when and how the buyer will pay to the seller and in which form. Will the buyer pay in cash? Will the buyer pay in physical consideration, with in-kind consideration? How will the buyer pay to the seller? It must have a commercial substance. It must not be a gratuitous contract. Gratuitous means free. The counterparty has to pay something in return. Otherwise, if it's a gratuitous contract, probably we have to look at another standard, maybe IAS 20, governmental grants, but it does not fall under IFRS 15. The probability to collect the consideration. If my customer is bankrupt, if my customer has very low liquidity and solvency, and there is a very high chance or probability that he will not pay for me, then we cannot apply IFRS 15. Agreements on the enforceable rights between the parties and enforceable obligations. One party delivers service or good, other party receives service and pays cash or other in-kind consideration. The enforceable right, the concept is based on governing laws, regulations, or other practices. And in the end, the most important concept of having a contract is it does not have to be in writing. Once I have a friend who came to me and they asked me, Maroon, I have this contract with the customer. I've been dealing with this customer for the past 3 years. We've been selling them goods and services, and they were paying for us, but we don't have any contract. Can we say that IFRS 15 applies? And my answer was certainly yes. IFRS 15 applies in this case, because regardless if the contract is in writing or is not in writing, we can apply IFRS 15. How can we verify that the contract exists? How can we verify that the sales is happening? As long as the counterparty is accepting the goods or service, as long as you are accepting the payment for the goods or service. If the counterparty is signing the delivery note, it means that they are accepting. If they are signing the progress work, it means they are accepting. Then revenue can be recognized, regardless if it is in writing or not. So one, there is contract mentioning rights and obligations of both parties. It is enforceable between them. It does not need to be in writing, and it must have a commercial substance. It must not be for free. If it is for free, then IFRS 15 would not apply. Sometimes when you are delivering a contract or a service, sometimes when you are delivering goods or service, you would tag along another service. You would add to the existing service another service. When you are adding to the existing service another service, we deal with the two services that you are rendering as one performance obligations. We deal with them as one contract, one if they are negotiated as a package, as a single commercial objective. For example, if you are an architect and you are decorating or you are doing some internal work for a building, and then they ask from you to do the external architecture of the building, this can mean that those are a single contract. Those can be treated as single contract. Regardless if in the first contract you signed that you are taking, for example, $100,000 for the interior design, and then you signed $50,000 for the exterior design, you can combine the 100 and the 50 and consider both of them as one performance obligation. The second one is to combine two contracts is that the amount of consideration to be paid in one contract depends on the price of the other contract. This is another condition for two contracts to be treated as one contract. Or the third condition is that goods or service promised in the contract are a single performance obligation. So even sometimes you might have two separate contracts, but the two separate contracts would be treated as a single contract if they have a single commercial objective. The price of one contract depends on the price of the other, and you have a single performance obligation. And those are the three conditions that I'll mention here. Single commercial objective, this is one of them. And the second one is the price. And the third one is the performance obligation, if it is a performance obligation. Okay? The second step is to identify the performance obligations in the contract. The performance obligations, or the set of explaining what the performance obligation is the most important step in revenue recognition. Because based on those performance obligations, based on the number of performance obligations, you will be able to allocate revenue later on. If I have one performance obligation, I'll be allocating all the transaction price to this performance obligation. But if you have more than one performance obligation, you will have to allocate the revenue to all those performance obligations in relation to the standalone price of each and every performance obligation. The performance obligations can be explicitly mentioned in a clear way, and it must indicate the rights and obligations of each party in the contract. You, as a buyer, your right is to receive the good or service as agreed with the seller. Me, as a seller, if I am the seller, my right is to receive the payment. And the payment doesn't need to be in cash. The payment can be a consideration of in-kind. The payment can be a service from your side. It does not have to be in cash. We identify the payment terms, and the contract must have a commercial substance. Gratuitous contracts do not fall under the standard. Gratuitous contracts are contracts that are considered as government grants, and they don't fall here. So the contract must have a commercial value where the buyer is settling or paying to the seller. There must be a probability of collection. If my customer is illiquid, if my customer is insolvent, if my customer cannot pay me, revenue recognition does not apply, because this also means it doesn't have a commercial substance. This means that I'm doing my customer a favor. This means I would be recording revenue against the receivable that I will never collect. So why to record it from the beginning? Moreover, we must have enforceable rights, and a very important concept of having a contract is that it does not have to be in writing. Many people ask me, if it's not in writing, how can we verify, or how can we prove that there is a contract? How can we prove that I'm delivering something to the counterparty and they are accepting it? How can we prove that I have performed my obligation? Once the counterparty accepts your goods, once the counterparty approves the service delivery, once the counterparty signs a completion certificate, this means that the counterparty is confirming that they are receiving the good or service. Once you accepted the payment, this means that you are receiving your rights and you are accepting your rights in the contract. So this can prove that you are actually delivering the service and the counterparty is receiving the benefit. Sometimes we can have two different contracts, but we have to treat them as one combined contract. We have to treat them as one single contract. To treat them as one single contract, either there is a single commercial objective, or there must be a price in one contract that is related to the price in the other contract, or the third component is that they are both considered as a single performance obligation. If those conditions exist, then you treat both contracts as one contract, and the revenue in both contracts is combined together, and you can recognize revenue over that period. The second step in revenue recognition is to identify the performance obligations. The performance obligation is a task. It is an obligation. It is a job, a service, a good that you will have to deliver as a seller to the buyer. Sometimes they are explicitly mentioned in the contract, and sometimes they are implicitly mentioned. So this step is very important because based on the number of performance obligations that you determine, the revenue or transaction price will be allocated to the performance obligations. The performance obligations can be distinct performance obligation, which means it's a one performance obligation that you would do. For example, one visit to your doctor is one performance obligation. One car that is sold is a one performance obligation. However, the performance obligation can be a series of goods or services that are interrelated or substantially the same. For example, daily cleaning. If you signed an agreement to provide a daily cleaning over a full month, you are visiting the client for twice a week. Twice the first week, twice the second week, twice the third week, and twice the fourth week. Even if you are visiting the customer for 8 times, this does not make them 8 distinct performance obligations. Those are still considered as a single performance obligation that is delivered over a period of time. Or let's assume that you are a contractor and you are providing construction service. Yes, you will buy the steel alone, you will buy the sand alone, you will buy everything alone. But at the end of the day, the performance obligations that you are delivering, the performance obligation that you are rendering are one single performance obligation that is performed over a period of time. When we look at this example, we'll understand more. Sunrise Company sells a cable TV system to Abdullah under the following terms on 1 January 2019. Abdullah has to pay a monthly fee of $80 for 12 months. And Abdullah receives a cable TV set-top box and access. So he receives a cable TV and an access to the TV channels. In this case, does the contract include one distinct performance obligation or 2 distinct performance obligation or 1 combined obligation? So do you consider here we have more than 1 performance obligation from Sunrise to Abdullah or 1 performance obligation? So the question here is to verify if we have more than 1 performance obligation or only 1 performance obligation. If we look at it, we can see that Sunrise is delivering 2 things. One, Sunrise is delivering a good, and the good is the cable TV. And the second thing that Sunrise is delivering is a service. And this service is the access over 12 months. So in this case, we can see that the company is delivering 2 performance obligations. The first performance obligation is the good, which is the cable TV. And the second performance obligation is the service, which is the access to all TV channels over the next 12 months. This point is very crucial and important in the revenue recognition standard, because once you know if we have 1 performance obligation or 2 or 5, we'll be able to know how to allocate the transaction price to those performance obligations. So here, Sunrise Company has 2 separate performance obligations. 1, delivering a set-top box, which is a good, and 2, delivering a cable TV access for 12 months. And by identifying that here we have 2 separate performance obligations, we'll be able later on to allocate the dollar revenue on those 2 separate performance obligations. Okay? The third step is to determine the transaction price. As much as the transaction price might seem simple, as much as the transaction price might seem straightforward, but there are some challenges in determining the transaction price. First, transaction price is the consideration to which the entity is entitled for transferring the goods or the service. This amount is based on an estimate of the best estimate or weighted average approach. And if we receive non-cash consideration, it is measured at fair value. The non-cash consideration can be in kind, it can be services received in return, or it can be products or goods received in return. Now, there was a huge elaboration in IFRS 15 on the effect of time value of money. The effect of time value of money takes into consideration when you deliver the service today, when you deliver the service or good today, but the payment will occur in the future. When the payment occurs in the future over a period of more than 1 year, Under IFRS 15, we have to consider that the sales that we are rendering to our customer is not only a sales of a good or a service. It is a sale of a good and a service in addition to a financing. So you are servicing the customer as a bank. You are dealing with the customer as if you are a financing party, and hence you are not only delivering to the customer the good or the service, but you are also delivering to the customer a financing component. And here we should recognize revenue based on the present value of the cash flows. So let's assume that you sold to a customer a service today, and the customer will pay in 18 months $100,000. Your revenue will not be $100,000. Your revenue will be the present value of $100,000, and the difference between the present value of $100,000 and the $100,000 is interest expense. So deliver today and collect in the future. The example that I gave is whether you are delivering today, for example, the service or the good, and the payment will occur after 1 year, then you should recognize revenue at the present value, and the difference between the present value and the future amount is considered as interest expense. So difference between revenue, nominal amount, minus present value of cash flows is equal to interest expense, interest income. Okay, so some customers provide the customer or the entity. For us, it is interest income, Steve. Good thing. For you as a seller, it is interest income. Because you are selling, you will collect 100,000 in 1 year, right? The 100,000 that you will collect after 1 year is not fully in relation to the good or service. There is a component of this amount which is considered as interest income for us as a seller. For the buyer, it is interest expense, yes. But for us as a company who's recognizing revenue, it is interest income. Exactly. You are essentially financing the buyer. Instead of asking the buyer to pay for you cash today, for example, 92,000, you are telling the buyer you have to pay me 100,000 in 1 year. And to add on this, even if it is not mentioned in the contract, even if it is not mentioned anywhere, you have to assume that implicit in the selling price, there is an interest component and interest income for you. So if you make a sales to the customer, if you are a pharmaceutical company and you sell to the Ministry of Health over financing term of 400 days, this applies. There is interest in the payment. If you are a company that sells to the Ministry of Defense Services, if you are a company that sells to any counterparty and you tell them you have to pay me after 1 year, then there is an interest income component within the selling price. And this interest income component is identified by calculating the present value of cash flows, and the difference between the present value of cash flows and the nominal amount that you will receive in 1 year is considered as interest income to the seller and interest expense to the buyer. Okay, this should apply to any contract, but it is optional if the payment is within less than 1 year. It is optional but not prohibited. So if you are selling to a customer and the customer will pay you within 8 months, you can still apply the time value of money. You can still recognize revenue at present value, but standard setters mentioned that it is optional. Why? Due to the cost over benefit. There will be a high cost to manage the payments, the schedules, the recognition, and accounting for those. So they tell you it's okay if you do not apply the time value of money for contracts where the payment is within less than a year. The second area that IFRS 15 expanded on is the cases of variable consideration. Variable consideration is the consideration that might occur or might not occur in the future after some uncertainties are resolved, after some factors that outside the company's control resolves. So basically, variable consideration is a payment that the company can be entitled to in the future, or it is a discount that the company might give to the customer in the future. What is the rule in this case? The rule in this case is that you must recognize the minimum amount that is highly probable of not reversing. And now we'll see what is the minimum amount that is highly probable of being not reversed. Examples in this case can be discounts that the company provides to the customer. Another example can be refunds and incentives that you give to the customer, penalties that you charge on the customer, or price concessions. Let's take an example here and then you'll understand. An entity sells machinery for 100 CU today plus a bonus of up to 5% based on the machine meeting future efficiency targets. Since we have a future efficiency target, then this is an unknown. We have no certainty in this case, and then variable consideration might apply. There is evidence at inception that it's highly probable that the bonus will not be less than 3%. Will not be less than 3%. If we go back to the terminology in the standard says must recognize the minimum amount that's highly probable of not reversing. So in this example, we are saying that we have a 3% as a minimum. The bonus will be minimum 3%. So what is the amount of revenue to be recognized in this case? Do we recognize revenue of 100, 105, or 103? So first option is 200 and ignore the bonus completely. Second one is 105 and recognize all the bonus. And the third is 103 and you recognize part of the bonus. What do you think is the amount that should be recognized as revenue, or what do you think is the transaction price? 100, 105, or 103? So the company would either recognize 100. That's right, Sharif. That's right, Steve. The right answer is 103. Why? Because the 3% is the amount that would not reverse. It is the amount that, it is the minimum amount that is highly unlikely to be reversed. I'm going to give you another example now. An entity sells machine. So this is the answer. Revenue of 103 is recognized as the minimum. The second example is CD company had contracted to build a property 75% chance that the construction will be completed by the specified date. So we have 10 million agreed price plus 2 million in case we complete it by a certain date. How much do you think revenue should be? Should revenue be 10 million? Should revenue be 12 million? Or revenue should be 10 million plus 2 million? So CD company agreed to build the property for 10 million plus 2 million bonus. But this 2 million bonus is conditional on completing the construction at a certain date. There is a 75% chance that the construction will be completed by the specified date. Steve is saying 10. Any other opinions? Is it 12? Can it be 12? Is it possible to be 12? Aruf is saying 12. It can be 10, it can be 12, or it can be 11.5. The 11.5 is equal to 10 plus 75% of the $2 million. Sharif, any idea? Ahmed? Steve changed his opinion. It's nice to be flexible. Highly probable, 75%, highly probable. Okay. The right answer is 12 million. The most likely outcome is that the bonus will be paid. There is a high probability that the bonus will be paid. It is a one-off event that either the bonus will be paid or the bonus will not be paid. So it's either 0 or 2. There's nothing in between. Okay? Since this is a one-off transaction, since this is a one-off event, you don't take the probability weighted. We take the most likely outcome. And the most likely outcome in this case is 75% that it will happen. Then you include all the 2 million. Why? Because it is most likely and probably they're gonna take the 2 million. They're not gonna take 75% of the 2 million. They either take 0 or the 2 million. And since it's 75% that they will take the 2 million, it's considered that it's highly probable. When we say something is probable, a probable event is 50% plus. When you go to 75%, it's highly probable. That's why we can recognize the revenue in this case. Okay, so those are examples of conditional consideration that are received over and above the initial contract, and those happen, we recognize them based on the most likely outcome. So included in the transaction price only if it is highly probable that there will not be a significant revenue reversal. The indicators of the of that something will be highly probable. One, you need to look at the experience with similar items. So to decide if you will recognize it or not, yes, that's right. Use the most likely for conditional events in the, yes, the amount that you don't think will reverse. Here you need to apply professional judgment. In the first example, we said that the minimum amount that we'll get as the bonus is 3%. So we booked 3%. Because in the first example, you can get either 1% bonus or 2% bonus or 3% bonus or 4% bonus or 5% bonus. What's the minimum amount that you would say you receive? 3%, so you book 3%. In the second example, it's either you get 0 or you get 2 million. There's nothing in between. And there's a 75% chance that you will get the 2 million. The standard does not tell you it has to be virtually certain. It tells you it has to be highly probable. Highly probable means 75%. If the standard told you it must be virtually certain, then those are not areas of uncertainty. Those become areas of certainty. Okay? So in the first example that we gave, the customer can pay either 1% bonus or 2% bonus or 3% bonus or 4% bonus or 5% bonus. In the second example, the customer will pay either 0 or 2 million. So in this example, it is up to, in this example, it is up to 5%. Since it is up to 5%, this means that the customer can pay you a bonus of 1, 2, 3, 4, or 5. And since it cannot be less than 3%, then 3% is the right amount. In this example, the customer will pay you 2 million if you achieve the date. If you did not achieve a date, there is 0. They did not say a bonus of up to 2 million. Then it will be 75%, which is the most likely outcome or the most probable outcome. And the revenue should be 10 plus 2. The revenue should be 12 million. Okay? Only if it is highly probable. Let's look here at the transaction price. Again, the same example. Sunrise Company sells cable TV system to Abdullah under the following terms. Abdullah has to pay $80 for 12 months. So in this case, what is the transaction price? In this case, it is $80 times 12 months, which is equal to $960. Although the standalone price for the TV alone is $250, and the standalone price for the service is $65 a month. If you take $250 plus $65 a month, it is much more than the total transaction price, which means that when we combine the two performance obligations, when we combine the first performance obligation, which is cable TV, plus the second performance obligation, which is access to the TV channels, by combining the two performance obligations, we discounted the price to the customer from a total of $250 plus 65 times 12, which would be 1,030. We discounted it to a lower price, which is $960. Okay? So this is the 960. Do we apply time value of money? We ignore the time value of money since there is no deferred consideration and there is no variable consideration in this case. Step number 4 is to allocate the transaction price. So now, as you see in this example, I have one transaction price, which is $960. How much of the $960 should go to the service and how much should go to the TV? Entities that sell multiple goods or services in a single arrangement must allocate consideration to each of those goods or services. The allocation is based on the price that an entity would charge to a customer on a standalone basis, which means if the customer bought only the TV or the customer bought only the service, how much the customer would have paid. And then management should look at observable standalone prices, and the entity does not need to estimate the standalone price if such data does not exist. They can go to the residual price is 80 times 12. How much of the 80 times 12 should go to the cable TV, and how much of the 80 times 12 should go to the access? To determine this, I prepared for you a table. The standalone price for the box alone is $250. Where is this mentioned? This is mentioned in the given. The setup box by itself for $250. The standalone price for the monthly access is 65 times 12, which is 780. So the total of standalone prices is 1,030. The box constitutes 24.3% of the 1,030. The monthly TV access constitutes 75.7% of the total standalone prices. So I allocate pro rata. 24.3% times the 960 gives us 233, and 75.7% times 960 gives us the $727. So the amount of revenue to be allocated to the box is 233, and the amount to be allocated to the monthly access is 727. This is the allocation of the transaction price. Now the last step is to recognize revenue. How do we recognize revenue? We recognize revenue when the entity satisfies the performance obligation. In this case, we have two performance obligations. The first obligation is to deliver a box that's usually delivered at a point in time. And the second obligation is to provide a monthly access that is usually provided over a period of time. So here we should look, what are the transactions or what are the obligations that we are rendering at a point in time, and what are the transactions that we are rendering over a period of time. Transaction, when does control transfer over time from a seller to a buyer? Transactions are transferred, or performance obligations are transferred over a period of time when the customer receives and benefits from the service over time. This is an example. So customer receive and benefit as the service is performed. The second one is when we are enhancing or creating an asset for the customer. For example, constructing a house for the customer, providing a car refurbishment to the customer. This is considered that the customer is receiving the service over a period of time. And the third example that the service is performed over a period of time is when the service or good does not create an asset with an alternative use. This created a big difference in the revenue recognition for construction companies, not for construction companies, for real estate developers. If I am a real estate developer like Amar, in the past, I had to recognize revenue once I delivered the apartment. Once I delivered the title from Amar to the customer, we used to recognize revenue. Under the new revenue standard, Amar does not have to wait to deliver the full completed house to the customer to recognize revenue. Why? Because one, Amar is creating an asset with no alternative use. So Amar is creating an apartment. If I am selling an apartment for Steve, I'm developing the apartment for Steve, I am doing the fit outs for the apartment based on the requirements of Steve, then I am creating an asset with no alternative use, and then I have the right to recognize revenue over a period of time. So the difference between the old standard and the new standard is that based on the old standard, the companies, the real estate developer had to wait to deliver all the asset to the customer, and then they recognize revenue. Under the new standard, this is not necessary. Under the new standard, since you are creating an asset and the customer is benefiting from it, and the customer is benefiting from those modifications of the asset, then we can recognize revenue over a period of time. When does control transfer? At a point in time. Control transfers at a point in time when you have either a right of payment, or it's not and, or the customer has accepted the asset, or legal title to the asset have passed from the seller to the buyer, or there is physical possession of the asset, or the last example is when the customer has significant risks and rewards, or significant risk and rewards were transferred. In the past, under IAS 18, all the focus was transfer of risk and reward. Under IAS 18, they used to tell you revenue is recognized when there is a significant transfer of risk and reward. Under IFRS 15, the word risk and reward still exists, but within the component of control. So from now on, you have to focus on control. When does control transfer? Control transfers when you have the right to payment, when the customer accepted, or the legal title of the asset transferred, or the customer has the physical possession, plus there is a significant transfer of risks and rewards. And those are the indicators of control. Okay, let's go to the example here. In this case, when do we recognize revenue? We recognize revenue from the sale of the box at a point in time. Why? Because the box is transferred from the seller to the buyer at a point in time. The buyer is accepting, the seller has a right of payment, the buyer is benefiting from the risks and rewards of the box. Whereas regarding the service, regarding the monthly access, the monthly access is over a period of time and not a point in time. Now, Steve, a very good question. Thank you for the question, Steve. Must all 5 indicators be present? No, not all 5 indicators must be present, because you can benefit from the right risk and rewards without having legal title. Even if you don't have the legal title yet, you can be benefiting from the risk and reward. Even if you don't have the physical possession, and that's the example that I gave for the contractors, for the real estate developers. If now I am buying an apartment, if I'm buying an apartment from Amar, I signed the agreement for Amar and I asked Amar to do modifications to the apartment. I decided on the tiles, I decided on the kitchen, I decided on the bathrooms. I decided on certain things that Amar will have to give me. I do not have physical possession of the asset. I do not have legal title, but I'm liable for Amar because they are enhancing an asset for me, so revenue should be recognized. Sometimes you don't own the assets, you don't have physical possession of the assets. For example, in shipping industry, or if you are selling goods from one location to the other. If we are selling goods from Dubai and shipping them to France, the customer in Paris might not have the legal title yet, or might not have the physical possession, but they have the right to direct the use. They have the ability to direct the use. Then revenue can be recognized. So answering to your question, the answer is no. Not all 5 indicators must be there. And remember, those are only indicators. Other indicators might be in place that indicate that control was transferred at a point in time. But those are indicators, those are examples of indicators that indicate that control is being transferred from the seller to the buyer. Okay? So going back to our example, the box is transferred at a point in time. The monthly access is satisfied over a period of time. So here, Sunrise Company should recognize revenue from said box at a point in time, which is on the date of delivery. On the date that they delivered the box to Abdullah, they have a receivable for Abdullah from Abdullah for 233, which is the allocated price to the TV box, and revenue of 233. Now later on, they started providing TV access. Every month they are receiving cash of 80. This 80 that is being paid, part of it is to cover the revenue from the service, which is the TV access, and part of it is amortizing the receivable from Abdullah, because Abdullah already received from us the TV box and he's using it. Once we deliver the TV box to Abdullah, we can conclude that we provided or we delivered to Abdullah a good at a point in time. Once we are providing the TV access to Abdullah, we can consider that we are providing a service to Abdullah over a period of time. So for Abdullah, we have good at a point in time, which is equal to TV box, and we have a service over a period of time, which is the access to the channels. The good that is delivered at a point in time, we can recognize once we deliver the good, and for the service over a period of time, we recognize them with the passage of time. And those are the 5 steps model that IFRS 15 introduced. Every contract with the customer, you have to approach it based on those 5-step models. 1, to identify if there is a contract between the seller and the buyer, to make sure that there are rights and obligations. It is not gratuitous. There is a commercial substance for the contract, and remember that it does not need to be in writing. Step number 1, identify that there is a contract with rights and obligations and right for payment. You are not selling someone who is bankrupt. You are not selling someone who will not pay you. You are not delivering something for free. Otherwise, this would fall under grants. This would fall under gratuitous deliveries. 2, identify the performance obligations. What are you offering to the customer? Are you offering the customer one good, one service, multiple goods, or multiple services? What are you offering to the customer? 3, identify the, yes, sure, Steve, we will share with you the slides. Now, once you give us the emails, please write down your emails, and we will send you the slides as we finish the presentation. So step number 3 is to identify the transaction price. Step number 4, allocate the transaction price to the performance obligations that were identified in step 2. Step number 5, start recognizing revenue either at a point in time when we deliver the good or service, or over a period of time when we deliver the good or service. And this is the 5-step model under IFRS 15. Do you have any questions? You are welcome, Steve. Most welcome. Any other questions from the other participants in the window? Amina, yes, you can visit our website. When you go to our website, www.meirc.com, I will type it over here, .com. You go to the webinar section. In the webinar section, there will be the recording over there. But please, I would like to apologize for the first 5-10 minutes, because some of you were not hearing me talking, so I had to repeat all over again. So starting the 10th minute, I repeated what I covered in the first couple of minutes because we had a technical glitch and some participants were unable to hear us. If you go to the page of Meirc.com, on the webinar section, you will be able to watch the recording of the session. And in case you have any question, you can reach out to me, to my email. This is my email. My email is mzghaib@meirc.com. I will be happy to serve you. I will be happy to assist you with any questions you have regarding IFRS 15 or any other IFRS. Thanks a lot for attending this webinar. You can watch it whenever you want on the Meirc website on the webinars page. And if you need any assistance or questions regarding IFRS, feel free to send me an email and we'll be chatting together. Thanks a lot.
Meirc.com